Good afternoon. My name is Edward Seiler, and I am the Executive Director of the Research Institute for Housing America, REHA. REHA is a 501c3 trust fund originally established in 1953, and our chief purpose is to encourage and aid through grants and sponsored research to distinguished scholars, educational institutions, research facilities, and government organizations the pursuit of knowledge of mortgage markets and real estate finance. In addition, REHA grants may be made to further understanding how to expand rental opportunities and home ownership among the undeserved and how to encourage equal access to mortgage credit. Today, I'm delighted to introduce Dr. John Weicher. John is well known in housing circles. He was the FHA Commissioner from 2001 through 2005. He was Assistant Secretary for PD&R at HUD and Chief Economist at HUD and OMB. In the days before the COVID really started, on March 10th, we met and had lunch, and I was really happy to meet with John. John and I are both graduates of the University of Chicago Economics PhD program, and it was really great to be able to learn about John's days. Many of his peers happened to be my professors when I went in the 90s. Before meeting John, I had the pleasure of reading his Oxford University Press article on the distribution of wealth from 1998 to 2013, and was excited at the prospect of John being able to write a piece for REHA. MBA is very focused on the relationship between homeownership and wealth generation and how the US will benefit from narrowing through homeownership the race ethnicity gap in homeownership. John's REHA paper is a riveting read, and despite writing it before the 2019 Fed Survey of Consumer Finance's data was available, John uses his experience not only to trace the evolution of the distribution of wealth among households from the Great Recession through 2016, he also follows through with a lot of intuition and knowledge about how the distribution evolved up through the summer of 2020. John is the Senior Fellow and Director of the Center for Housing and Financial Markets at the Hudson Institute in Washington, D.C. He is the author, co-author, or editor of 16 books or monographs, and the author of numerous popular and scholarly knowledge. He holds a BA from the University of Michigan and his PhD from the University of Chicago. Without further ado, John, over to you.
Thank you, Eddie. It's good to see you.
Thank you.
Time in 10 months. It is good to see you, even if it's not in the flesh. And thank you for those kind words. And especially I want to thank Research Institute for Housing America for supporting this study and for publishing it. I'm glad to hear the kind things you're saying about it. Two things happened to the wealth of American households after the Great Recession started at the end of 2007. First, the distribution of wealth became more unequal. And second, the wealth of the typical family dropped sharply and did not recover, at least not by 2016. I want to talk about these changes, what happened, and who was particularly affected. I'm using the Survey of Consumer Finances, which is the most extensive information we have about the distribution of wealth in the United States. The survey has been conducted for the Federal Reserve Board every 3 years since 1983, with extensive interviews of several thousand American households about their assets and their liabilities. Each survey has a different sample. It's a voluntary survey. If you're rich, you'll spend a long time at responding to all the questions, and you won't want to do it a second time. But the surveys include the same kinds of people in about the same proportions from one survey to the next, and they enable us to track what's been happening to our wealth over that period. Now, this table shows the changes in our wealth over a quarter of a century, starting in 1992 and ending in 2016. It shows wealth in real terms in 2016 dollars, adjusting for inflation. I'll be talking in real terms, 2016 dollars throughout this analysis. Now, the years from 1992 to 2007 were very good, generally very good indeed. Our total wealth in 2007, just before the Great Recession started, was 2.5 times what it had been in 1992. Our mean wealth, our average wealth, was more than twice what it had been in 1992. Now, our median wealth, the wealth of the typical household, the household in the middle of the distribution of wealth, increased by about 2/3 in those 15 years. Then the roof fell in. From 2007 to 2010, the total wealth of American households dropped by $11 trillion, back to where it had been in 2004. Our average wealth, our mean wealth, dropped by $100,000 in 3 years, back to almost where it had been in 2001, 9 years earlier. Our median wealth dropped by over $50,000, almost back to where it had been in 1992. Not much happened. There were small changes between 2010 and 2013. But then between 2013 and 2016, our wealth increased by $20 trillion in 3 years. That's a very large increase. And the 2016 figure was an all-time record. Our average wealth increased by $150,000, almost $150,000 to $690,000. And that also was an all-time record. Our median wealth, the wealth of the typical household, didn't increase that much. It increased by less than $15,000 by about 15%. And it was less than it had been in 2007 and less than it had been in the years before that, back almost to 1995. That's an overview of what happened during the Great Recession. Now I'm going to take a look at the composition of our wealth during those 10 years. These are the assets that most households owned. Almost all of us had checking accounts, and almost all of us owned a car throughout the period. 2/3 of us owned our home. Over half of us had retirement accounts. These 4 surveys constituted almost half of our total wealth in each of those 4 surveys, about 45%. Now you'll notice that a smaller percentage of us owned a home as the Great Recession continued. This next table shows which assets were most important, measured by their dollar share of our total wealth. Our homes were our most important asset. Almost 30% of our wealth during the Great Recession, even though the homeownership rate was declining and house prices were decreasing, dropping from 2007 to about 2015. The second most valuable asset was the holdings that we had of stock in publicly traded companies. Now, we own stock in many different ways. Traditionally, we own stock by buying it on the New York Stock Exchange or the Chicago Exchange or some other way. And we would often put the stock certificates that we got when we bought the stock in our safe deposit box. Now, that's somewhat passé now. We have several other ways of owning stock. Most of us own stock, and most of the stock that we own indirectly in our IRAs, as part of our mutual funds or in trusts of which we're the beneficiaries. The most common way of owning stocks, and increasingly the most common way of owning stocks, is to own them as part of our retirement accounts. This chart shows the growing importance of retirement accounts over the last 25 years. I should mention retirement accounts were created in 1974 and extended to all full-time working taxpayers in 1981, and they've been growing pretty steadily ever since. Now in this chart, the blue bar shows the proportion of households who owned stock. in any way in each survey. The brown bar shows how many of us had retirement accounts. As you see, those two figures, those two numbers move together pretty steadily between 1992 and 2016. And that's also the case before 1992. The green bar shows the percentage of us who own stocks directly. And as you can see, that's a lot less. And it didn't move up very much in the 1990s, and it's been dropping from survey to survey since 2001. Our third most important asset is the businesses that we own. That's over 20% of our wealth. Now, these are not shares in a publicly traded company. These are businesses we own and we personally manage in most cases. We're the proprietor, we're the sole owner, or we're in a partnership, or we own a professional, or we're part of a professional practice, law or medicine, for example. Or we own shares in a closely held corporation, one whose shares are not publicly traded. There are a lot of these corporations in America, and some of them are quite large. A few years ago, the Forbes people put together a list of over 500 closely held corporations, all of which had $1 billion, pardon me, in revenue in the previous year. And they include a number of very well-known corporations. Cargill, the global food company based in Minnesota, has been the largest of these closely held corporations most of the time over a long period. There's also the Publix grocery chain, the Mars Candy Company, the Staples chain of office supply stores, all of them big, closely held corporations. Now, in talking about wealth, we usually classify households by how wealthy they are. We focus on the rich. And by the rich, we mean any one of a number of things. The richest 1% or 5% or 10% or 20% or 25%. All of these figures are used to define the rich by one or another analyst. Now, if you focus on the rich, you're not giving very much attention to anybody else. You're not giving much attention to the poor or the people who are in between being rich and poor. You need to classify households by how wealthy they are, but it's also useful and illuminating to classify households by the composition of their portfolios and not just by the size. In this study, I've used three categories, which I found useful: rich households, poor households, and the households in the middle. The dividing lines between these categories don't change much from one survey to the next. The richest 10% were millionaires on up to billionaires in each of these surveys. The poorest 30% had no more than $30,000 in net worth in 2007, less than that in 2010 and later. And this includes people whose net worth was negative. About a good minor fraction of these households had negative net worth. And in between, there's most of us, 60% of us, everyone who had more than $30,000 in wealth, on up to everyone who had $1 million or a little bit more. Now, these boundaries are stable, and that's because the composition of the wealth of each group didn't change much during the Great Recession. And it is sharply different for between each of the groups. The richest 10% of us, the millionaires, basically they own and manage businesses and they invest in publicly traded stocks. That's over 60% of their wealth. More than half of them own a business. They own and manage a business typically, and that's 35% of the wealth of the rich. Nearly all of them own stock, and that's another quarter of the wealth of the rich. Most of them, nearly all of them, own their own home. Most of them have retirement accounts. That's a much smaller share. That's a much smaller share of their wealth. Basically, they're entrepreneurs and investors. The poorest 30% had a total wealth of $62 billion in 2007. Now, there are 35 million households in this group in 2007. average wealth of poor households in 2007 was less than $2,000. That was just before the Great Recession started. Most of them owned a car, and their cars were twice as valuable as anything else they owned. And that's net of whatever they owed on the car. Total value of their cars was $172 billion in 2007. The average value of their cars was about $7,000, net of whatever they owed on the cars. Not a large sum. Also, most of them had checking accounts. The total value of the balance in their checking accounts was about $69 billion. Their average balance was about $2,500. Now you notice that in each case, the total value of the asset was more than the total value of their wealth. There were a lot of poor people with negative net worth. Poor as they were, most of the poor people had a car and had a checking account. But so did nearly everybody else. Cars and checking accounts are necessities of daily life. They're not just assets. These assets were necessities for the poor, as well as for the rich and the families in the middle. And that's what they owned. Their portfolios were the necessities of life, and they didn't include much else. The 60% in between were essentially homeowners with retirement accounts. And their homes and their retirement accounts were 2/3 of their total wealth. Their cars and their checking accounts, which most of them had, were about another 10%. 20% of them owned a business, a small business, typically worth about $120,000, about 8% of the total wealth of this group. They weren't really entrepreneurs. They weren't really investors. They were basically, I think, looking towards retirement. By the time they retired, nearly all of them would have paid off their mortgage. They would own their home free and clear. And from then on, they could either live in their home rent-free or sell it and move into an apartment or a retirement home or something else that was convenient. And that would be, they would use the value of their home to pay part of their living expenses, along with their retirement account and probably with Social Security and a pension from a previous employer. But they were essentially looking towards retirement as they invested. Okay. These are very different portfolios. And the people who have these different portfolios are themselves very different. The groups are very different. The poor in 2007 were basically young people. Over half of them were under the age of 40. Over 30% of them were under the age of 30. The median age of the poor household in 2007 was 37 years old. A third of them were middle-aged, a few of them were elderly, but basically, poor households were young. And basically also, young households were poor. Over half of young households were poor in 2007. And that's compared to 20% of middle-aged households and 15% of the elderly. Now, as they got older, many of these poor households, these young poor households, were likely to move up to being at least families in the middle. But they were also, while were doing that, a lot of them, a quarter of them, had substantial debts. In particular, a quarter of them had an outstanding student loan with a balance of $25,000. Now, remember that the wealth of the typical poor family in 2007 was about $2,000. So they had a substantial student loan, and that essentially was one of the things that made them poor. And most of them had not gone to college. And most of them had not gone to college. A third of them hadn't finished high school. Another quarter, it did have a high school diploma, but didn't go to college at all. Not very many of them were college graduates. Just over half of them were white. The rich were the opposite in many ways. They were old. The median age of the head of rich households in 2007 was 58. They're well educated. 2/3 are college graduates. Half of those had advanced degrees, MAs or PhDs or professional degrees in law or medicine or some other field. Half of them had BAs. A few of them, a very small number of them, hadn't finished high school. Almost 90% of them were white. Who are the middle wealth families? Well, they are in the middle. They are between the rich and the poor in a great many ways. The median age of the head of middle wealth families in 2007 was 51, less than the median age for the rich, more than the median age for the poor. They have less education than the rich and more than the poor, very consistently. 30% of them are college graduates compared to 70% of the rich and 13% of the poor. 10% of them have advanced degrees, less than the rich, more than the poor. 14% didn't finish high school, more than the rich, less than the poor. And 3/4 of them were white, less than the rich and more than the poor. Now, these characteristics did not change very much for these groups. The demography didn't change very much from one survey to the next, with one exception. And that was the age of the heads of middle wealth families. The median age of middle wealth families was 3 years higher in 2016 than the median age of middle wealth families had been in 2007. Median age actually went up by 1 year from one survey to the next. The median age was 51 in 2007 and 52 in 2010 and 53 in 2013 and 54 in 2016. With that increase in median age, they were probably also 3 years closer to retirement in 2016 than middle wealth families had been in 2007. But they didn't have as much wealth as middle wealth families had in 2007. Their mean wealth in 2007 had been a little over $300,000. That dropped by $70,000, by more than 20% in the next 3 years. And it dropped a little more between 2010 and 2013. They had a partial recovery in 2016, but their average wealth in 2016 was still $40,000 less than it had been in 2007, down about 10 to 15%. Families in the middle lost over 20% of their wealth in 3 years. They regained less than half of it by 2016. Most of that loss is accounted by a drop in their home equity. In 2007, the average home equity was $157,000. It dropped by over $40,000 by 2010, a decline of more than 25%. Dropped a little more by 2013. They had a bit of a comeback by 2016, but their average home equity was still $30,000 less in 2016 than it had been in 2007. Most of the drop in their total wealth is accounted for by the drop in the equity that they had in their homes. Poor families took a bigger hit than that. The median wealth of the poor family in 2007 was about $3,500. By 2010, it was under $1,000. It was down by more than 3/4 in 3 years. And then it went down by another $200 between 2010 and 2013. The median wealth was between $500 and $600. In 2016, their median wealth had risen somewhat, but it was still less than $1,000, and it was still down by almost 3/4 in those 9 years from pretty low level to start with. Now, 20% of poor families had negative net worth in 2007. It was more than 35% in 2010, and it stayed more than 35% in 2013 and 2016. Now, rich families lost more money than either poor families or middle income families, middle wealth families. they lost $500,000 on average between 2007 and 2010. But they started with $4.5 million, and the drop in their wealth was only about 10% in 3 years. And it stayed there for the next 3 years. And then their average wealth went up by over $1 million between 2013 and 2016. They were richer in 2016 than they had been in 2007, richer by $700,000, richer by 15%. And their share of total wealth went up from one survey to the next throughout the Great Recession, from 71% in 2007 to 74%, and then 75%, and then 77% in 2016. And by 2016, we had the most unequal distribution of wealth than we had had since at least 1983. So we had good reason to be unhappy as the Great Recession went on. The distribution of wealth became more unequal. Poor families had less than 1/3 of the wealth they'd had in 2007, and a larger number of them owed more than they owned. Middle wealth families had less wealth and were closer to retirement. And middle wealth families and poor families together were 90% of us. And we were in worse shape in 2016 than we had been in 2007. Well, as Eddie said at the beginning, the study goes through 2016. But we do know some things that have happened since 2016. And a lot of them are very, very encouraging. The home ownership rate went up. And it went up especially for minority households. The Census Bureau classifies households in 4 groups: white, Black, Hispanic, and other, which is predominantly Asian Americans. The homeownership rate for all of the minority groups went up more than it went up for white households between 2016 and 2020. Unemployment dropped, also, especially for minority households. It was the lowest unemployment rate in 2019 that we'd ever seen for either Black households or Hispanic households since the Census Bureau started tracking unemployment for these groups separately back in the early 1970s, back over 50 years. The stock market hit new highs in 2020, as I'm sure all of us will remember. Our household income went up by a tidy 10% between 2016 and 2019, and that's the latest information we have at this point. Most of that increase occurred in 2019. The poverty rate in 2019 hit an all-time low, the lowest rate it had been in the 60 years since the Census Bureau started calculating it. Now, lower unemployment, higher income, lower poverty are all reasons to expect higher wealth. And then the coronavirus hit. And while the housing market remained strong, and the stock market, after setting a record for dropping during the early part of 2020, began to set records for increases in the latter part of 2020, and it's hit new highs again. And those are positive, but at the same time, the unemployment rate is quite a bit higher than it was. And the number of businesses in this country has been dropping, especially small business. And a large majority of us think that we are worse off now and the country is going in the wrong direction than we were 10 years ago or longer.
Well, thank you, John. You know, I've read the paper, and every time, you know, I hear the numbers, there's so many numbers to digest. It's fascinating, and I learn something new every time. Just wanted to, you know, to start off, you know, with a few questions. And first of all, you know, I think of you as being a housing expert, and really wanted to ask what got you interested in researching household wealth?
Well, it was almost an accident. When I left HUD in 1993, after I had been Assistant Secretary for Policy Development Research during the administration of President Bush with Secretary Jack Kemp, I became a visiting economist for most of a year at the St. Louis Fed. And when I arrived there, they had just released, the Federal Reserve Board had just released the 1992 Survey of Consumer Finances. And I was really impressed by how much of the wealth of American households consisted of the homes that we own. Most of the people who've been writing about the distribution of wealth focus on the stock market, which is fine as far as it goes. But our homes are a very large share of our total wealth. And I thought it was worth looking at what was happening to the distribution of wealth. And I've come back to that subject several times since then. I've written papers. You mentioned the paper I'd written, which went through 2013. I wrote other papers back in the late 1990s and the early 2000s. So I think it's perfectly reasonable for a housing economist to be interested in the distribution of wealth. And I'm sort of surprised that more of us haven't been looking at it, although more of us are from year to year.
Indeed, one of your main findings that strikes me is for the middle wealth families, that almost 30% of their wealth is in their home equity. Mm-hmm. And
yes.
There's been a lot of discussion recently about increasing minority home ownership that you just alluded to, and how this can help build wealth and decrease inequality, among households in the country. Can you further expand on this topic and describe the patterns in the decade after the Great Recession?
Well, the home ownership rate among minority households has consistently been lower than the home ownership rate for white households. And what's been happening just gradually is that the opportunities for home ownership have been increasing for minority households, not particularly in leaps and bounds, but generally it's been rising from year to year, except when we've had recessions or which was certainly the case in the years after 2007. The home ownership was dropping in that period, as I think all of us who've been in the industry know was happening in that period. But there's been outreach to minority households, which has gradually worked to make home ownership more readily available to them. And that is a big factor. I'm sure we will continue to expand those opportunities. And I am sure that minority households will be taking advantage of those opportunities as they become available, particularly when the economy is booming. The changes after 2016 were quite noticeable. Those home ownership rates increased pretty steadily through 2019. It's not quite clear what happened through 2020 because it's been harder to conduct household surveys during the pandemic. And response rates are lower than they had been in the past. But the best information we have is that the home ownership rate for minority households, the home ownership rates for minority households have been increasing since 2019. And that's to the good.
Great. No, this is something we're looking very closely at, and as you just alluded to, the home ownership rates from the census HVS home ownership and vacancy surveys have been thrown off a bit because of the pandemic. But can you perhaps expand on the relationship between home ownership. We know that house prices have been shooting up this year. Recent data, show that Case-Shiller data is almost hitting double digits again in house prices increasing. Can you expand a bit more on the mechanisms between home ownership and wealth, especially as as a lot of popular writing has been writing that perhaps if we can get more people into homes, especially minorities, we'll be able to raise all ships. Can you expand a bit more on that, please?
Well, to start with, every time house prices go up, homeowners are wealthier. Those of us who are homeowners are wealthier. We bought the house we live in 1977. We paid off the mortgage, we built onto the house, and it is a much larger share of our wealth than it was when we bought it. And I think that experience is typical of people who've owned their house over an extended period of time. And I think that's, we probably, in the next recession, whenever that comes, we will probably see some decline in our wealth, the wealth that is in our homes. But it's never, the long-term trend has been pretty steadily up. And most of us own our homes, and most of us benefit from that. And if the home ownership rate is going up and house prices are going up, that tells you that there is a stronger demand for housing now than there was a while back. And that is to the good.
Great. So you also had a really fascinating discussion in the paper on recent changes in policies. For example, the expanded retirement savings vehicles and the limited mortgage interest deductions. What have the effects been of these policies, in your opinion? And what are some of the policies you would recommend to the incoming administration?
Well, I think what's happened has been the expansion of the opportunity for a retirement account. It's now available to people who do not work full time, which means it's available to people who are doing gigs rather than people who are stably employed by the same employer for a long period of time. That's a new opportunity, and certainly the extent to which we own retirement accounts has been increasing, and that's become a very substantial share of our wealth. And I think that's likely to continue. I wasn't too enthusiastic about the reduction in the value of the mortgage interest deduction for most of us. There are a couple of places, a couple of countries in Europe, advanced economies certainly, that have cut back on the mortgage interest deduction or essentially eliminated it over the last few decades. The United Kingdom is one, Denmark is another. And what's happened in both of them is that the homeownership rate among young families has dropped since the mortgage interest deduction was weakened or eliminated. And that means it'll take longer for people to become homeowners, and they'll have less period as homeowners to enjoy the benefits of the growing demand for home ownership, which I think is a demand that most of us have. And that's true, I think, of all of the countries where home ownership is significant. So I think I would be careful about any changes in tax policy which would reduce the incentive to become a homeowner in this country, especially coming out of the pandemic. I think we need to be careful about what we do that in the tax code that will make homeownership more difficult and later for more of us.
Right, right. And talking about the pandemic, you know, there's a lot of housing distress that many households are facing, yet there's been a lot of housing trends that we've seen, you know, for instance, migration that we haven't yet measured, but migration to the suburbs and beyond. What do you believe the pandemic's effect will be on the distribution of housing wealth in coming years?
Well, I don't know that it will make a change in the distribution of wealth when we look at households. I think the desire to own a home is likely to be increasing, if anything, since we read from time to time that the pandemic is more acute in places where people are crowded. I think some of the move to the suburbs and to the exurbs, the recent move, is a reaction to that, in all probability. But I think beyond that, we're going to see an increase in homeownership in nearly every part of the United States, for the reason that in nearly every part of the United States, there is the opportunity to move a little farther out and to take advantage of a little more room between people. When we were younger, we used to think about moving out to the suburbs. We live in the District of Columbia, and we've never acted on that. As I mentioned, we bought the house in 1977, and I doubt if at this point we will be moving out to the suburbs for any particular reason, but other people will be.
Great. Well, those are my questions, John. But wanted to know if you had any final comments you would like to make.
Well, you know, there is a common question that pollsters ask fairly regularly, a very simple question. Do you think the country's going in the right direction, or are we on the wrong track? For the period I've been talking about, from 2007 to 2016, we have consistently thought that the country has been moving in the wrong direction. In 2000, the Real Clear Politics website tracks this survey and updates it. There's a running average on this question of the most recent survey taken by each of the pollsters who may take this survey ask this question on a particular reasonable schedule. Between 2007 and 2016, I should say between 2009, which is as far back as Real Clear Politics goes, and 2016, there was one day in which half of us thought that we were moving in the right direction, half of us thought we were going on the wrong track. 45.8% said right direction, 45.8% said wrong tracks. There haven't been many times since then when as many as 40% of us said that we were moving in the right direction. We're on the, I think the only extended period where that was the case was in 2013. There have been at least two occasions where more than 70% of us had said we're on the wrong track, in 2012 and in 2014. I look at these polls from time to time, and 3 weeks ago, there was a survey which reported that over 70% of us thought we were on the wrong track. That's, I think, an indication of concern, not just about the pandemic, concern about the direction of the country.
Thank you. Some sobering thoughts.
Yeah.
Yeah, but I want to thank you, and of course the Hudson Institute for setting up today's webinar, and we look forward to better days.
And thank you, Eddie. And it is very good to see you. And I hope we manage to see each other face to face sometime in the next 9 months without all this these problems that we're having.
Exactly. Thank you.
Take care.